Good to be back here at Delphi. I will now return us to the English language portion of our program. There may be a time when I can do this in Greek and do a Delphi panel in Greek. Today is not that day, however, so I'll stick to English. My name is Peter Spiegel. I'm the U.S. Managing Editor of the Financial Times, and I'm joined here by CEOs of two of the four systemically important banks in Greece. As always at Delphi, a very well-timed panel. I leave New York for 3 days, and yet another bank seems to have fallen into insolvency. Incredibly well-timed time to talk about the banking system in general, and particularly what we call in the U.S. now March Madness, which was a period where we saw two big banks fail, including the second largest failure in American history, and obviously the events in Switzerland, which is interesting. And this is a topic that was discussed at the central banker panel, because we have here American banks and non-Eurozone European banks. And for someone who spent quite a bit of time in Brussels covering the Eurozone banking crisis, it was, I guess, a relief for the both of you and for most Eurozone banks that it was not a Eurozone banking scandal. Now, Vice President Guindos was pretty confident that that was because of things that had been done in the ensuing years. But actually, let me start with you, Fokion. Is the fact that Eurozone banks were not affected by the recent unsettling events, is that a time for Eurozone banking system to sort of pat itself on the back and say, we've got things right? Or is this a bit of a warning? Because although Luis de Guindos was right in that all three, and now maybe four of these banks are sort of idiosyncratic, they all have very different things that brought them down, it is true that when you raise monetary policy interest rates incredibly quickly, weaknesses get exposed much more quickly that you may not have seen elsewhere. So let me just start with a question to you. Should the Eurozone be pleased with itself over the events of the last 2 months, or should it be cautious and see this as a warning of something to come?
Okay, Peter, thank you for the question. And it is true that a lot of people blame interest rates for what we have seen during the last couple of months. But let me state that in general, interest rates, higher interest rates, is something positive for the banking sector, provided that we follow some very basic principles about interest rate management, liquidity, and so on and so forth. Now, the cases that we have seen with mainly SVB in the States, but also a couple of other small banks, and with Credit Suisse, I would say mainly are special cases, and let me elaborate on that. In the case of SVB, we had a bank with a sort of monoline business model, with a very high concentration of deposits from a single segment of its clientele, which is startup companies, with very minimal diversification of income and rather poor liquidity and market risk management. And it may sound counterintuitive, but SVB failed despite the fact that its asset quality was in great shape.
Yes, exactly.
Actually, a loan portfolio of good quality, and AAA bonds, US Treasury and AAA agencies. Someone could raise questions about the US regulatory framework. I think everybody accepts that it is a really sound system. However, there are exceptions applied to non-systemic banks, and obviously, this leave open loopholes. I mean, de facto has left open loopholes. And therefore, it is not unusual to see small-sized US banks failing. If we go into the last decade, more than 500 small institutions in the US have failed. So we are not seeing something very unusual. Now, the SVB case has triggered the failure of one more bank. Another one may be at risk. I cannot exclude that we see more incidents like that in the US. Now, Credit Suisse was a case by itself. We knew for quite some time that there were problems with Credit Suisse.
Yeah.
In my view, it was mainly an issue of culture, triggering a number of scandals. And if it was not the size and the reputation of the bank, and actually the unusually high deposit rates that was paying for some time to its customers, maybe we could have seen the exit of customers several months or several weeks before the incident. In Europe, we have definitely a quite robust regulatory system that became even more robust after the introduction of the SSM. And we have regular stress tests. 2023 is another year of stress test in Europe. We have the so-called regular on-site inspections for our asset quality, for our processes, procedures, and we have quite robust liquidity, market risk, and credit risk management systems. I would say that European banks most likely complain about the high burden of regulatory cost in Europe. In my view, what has happened in the US or what happened with Credit Suisse is rather unlikely to see that in Europe, and it is even lower the probability of seeing something like that in Greece.
Let me just follow up very quickly because this issue of those banks being idiosyncratic, to me in some ways it's a dangerous phrase in that a lot of the banks that came down during the Eurozone crisis, Anglo-Irish, Dexia, the Cajas, were small, slightly strange, idiosyncratic banks as well. And it was interesting what Degindo said about the things that sort of keeps him up at night was that the combination of the ability to start a bank run very quickly because of electronic banking, you don't have to go down to the branch anymore, combined with social media. Because as you said, Silicon Valley Bank, it actually, although it was a very small and select customer base, had a quite safe capital invested in treasury bonds. How concerned are you that even with a strong regulatory system, the banking system as it now functions happens at a rate and a rapidity that perhaps regulators can't get their hands around?
Yeah. I mentioned some key differences between the US and Europe. One more difference, which is quite important, is the liquidity lines provided by the central banks in Europe versus the US. In the Eurozone, we have a very robust framework for liquidity provided by the central bank, by the national central banks at time of stress. Actually, this system has been tested for quite some time during the Greek crisis, have been tested quite successfully during the Greek crisis. And this system is available for almost all the European banks. On the contrary, if I'm not wrong, in the US, access to the so-called Fend window is only for the larger banks.
Yes.
Banks like SVB or Signature Bank don't really have direct access to this system. And I think this makes a difference during time of stress when someone has to act very, very fast.
That's a fair point. Pavlos, let me ask you the same question, but ask it in a slightly different way, because Fokion made the point.
He exhausted most of the answer.
The answer is a good question. The answer, all the good answers, that's right. But he raised an issue that as someone who spent a lot of time writing and watching the Greek crisis and the Eurozone crisis more rapidly, was slightly surprised that the lessons of Greece were not passed on, which is this issue of what you hold in your investment portfolio, right? Everyone says you should invest in treasuries, it's such a good idea, it's safe, it's liquid. However, that is in many ways what brought Eurozone banks down. There was this phrase, the doom loop, right? You held sovereign debt, which is supposed to be safe, and then suddenly Greek sovereign debt went into the toilet. And so did Portuguese, and so did Italian. And so all the banks that were otherwise relatively safe had capital on their books that was suddenly worth nothing. And I'm just curious, two questions on this one. One, did the world fail to learn the lessons of the Greek crisis and the doom loop? But also, does someone need to recalibrate the safety of sovereign debt, particularly at a time when you see rates going up as fast as they are?
Okay. As Fokion mentioned, there's a question when you hold sovereign bonds of interest rate risk and how you handle it. And clearly, the case of the US right now, it was poor ALM, asset liability management, of the interest rate risk. The European crisis was a question of credit risk. There were questions about the ability of the sovereign to repay its debt. So it was a credit issue, and the whole question of whether the Eurozone was going to fail, and therefore there was a revaluation of the bonds due to credit, which hopefully will not happen again in Europe. But it was two different issues. Second point is the question of banks holding too much sovereign debt. Here, again, we have a regulator who looks at us and pokes us and tests us every year in our annual SHRP analysis. We have a risk appetite framework which we need to have approved and checked by the regulator that we are within fair and logical limits. There was a debate, which I think now has ended, about whether sovereign bonds should have a zero risk weight in Basel. And I think rather than applying a sort of horizontal rule that you need to risk weight sovereign bonds, which some countries still are pushing for, the more AAA countries clearly, it has gone to more that the regulator should look at a bank-by-bank basis based on their other assets and liabilities.
Let me ask you again, because you talked a bit about the regulatory authorities and the stress tests. One of the things that seemed to be the criticism in the US of the Fed in particular was monetary policy and macroprudential policy were two things being done by the same institution, but not really looking at each other. That the monetary authorities were raising rates so quickly, and the macroprudential authorities were not focusing enough on what that impact would be on the investment portfolios. How concerned, how comfortable are you that that is not the case in Europe, that the ECB, which also has monetary and macroprudential roles, I mean, obviously it's spread over other agencies as well, that there is more integration there, or do you think there needs to be more integration?
I think there's integration, but let's not confuse the two. One is a through-the-cycle policy, macroprudential. You don't sort of put on more macroprudential when you're going down. That's a pro-cyclical policy, and you don't want that. Macroprudential is putting a little bit of sand in the wheels of during the cycle. Okay, LTV ratios, loan-to-value ratios, PIT ratios, leverage ratios for highly leveraged firms that have high loans to EBITDA ratios, collateral valuations of ships. All these are ways of slowing things down on the upswing. Okay, and I think in Europe they're quite strict already. And getting stricter.
Go ahead.
Peter, on that, I think there is a very thin line between monetary policy and the level of interest rates, the credit dynamics in the economy, and asset quality.
Yes, that was my next question, yes.
And I think overall, central banks at a period when inflation is high and they're trying to bring it down, have a really tough job on trying to bring the level of prices down and at the same time achieve a soft landing of the economy. And we know from history that this is not always possible.
Rarely, probably.
And, but I would agree with Pavlos that macroprudential supervision and monetary policy should be two separate things. We cannot mix them. Although I cannot exclude the fact that when central banks make decisions, they have different parameters, and they should have different parameters in their mind about the effect of higher interest rates. And one thing that higher interest rates affect one way or another is asset quality. And we know that on both sides of the Atlantic there is already discussion about some segments of loans like commercial real estate loans that may be affected by the higher level of interest rates. I was reading some statistics, and it appears that European banks have on average a lower level of CRE loans as a percentage of their loan books versus the US banks. Leverage loans is another segment that may be affected. And if we want to move into the retail business, the retail segment of our loan portfolios, there are some jurisdictions in Europe that have floating rate mortgages that definitely are affected by higher interest rates. In Greece, what we see so far in terms of asset quality is that it remains broadly unaffected. It remains broadly resilient. First of all, the exposure that we have as Greek banks in CRE loans is very small. And it is very small for a simple reason: because of the 10-year financial crisis, the CRE projects in Greece were not many. Yeah. And as a result, as banks, we don't have exposure to this segment. But we do have floating rate mortgages. Actually, the majority of our mortgage books is with floaters. And this is something that we monitor very closely. We have not seen any sort of signs of that should concern us, but recently we have taken two measures as a banking system that should be considered as credit positive. One is the subsidies that we provide for vulnerable mortgage borrowers, and the second is a sort of horizontal interest rate cap that we have introduced a few weeks ago. As I said, both should be considered as credit positive and should provide also help to our customers.
You may have just answered this question, but let me ask it slightly in a different way. In that Pavlos was mentioning that sand in the wheels, right? That the effort right now by the central banks is to slow things down slightly. We heard the last two panels. Clearly, the election here in Greece is going to be, in a large part, campaigned on cost of living increases and whatnot. We have seen inflation start coming down, both in Europe and the U.S. But one of the things that came out of the U.S. was concerns about a credit crunch. That even if the banking system itself is relatively stable, and these are all one-offs, that there may be a drawback in lending, particularly corporate finance, into the real economy. And I'm wondering to what extent you are anticipating that here. It sounds like what you just said, that the asset quality seems to be pretty good, therefore not. But tell me, both of you, with both of your banks, what you're seeing, and if whether your lenders and your banks are being pulled back a little bit. And also, let me just ask a follow-up to that, which is that necessarily a bad thing? Because, as we said, if we're worried about inflation, if the banks are pulling back credit slightly, that kind of feeds into that slowing down the economy. So let me start with you, Fokion, and then Pavlos, you as well.
Credit crunch, I don't think that this is the right term.
Okay.
We don't have a credit crunch, but definitely credit conditions are becoming tighter. And are becoming tighter both in the US and in Europe. High interest rate means that the demand for loans, first of all, is becoming lower. What we have experienced in Greece over the first quarter of 2023 is a lot of our customers using excess liquidity to repay loans. And as a result, my impression is, I don't know if Pavlos would agree, that what we're going to report in the first quarter is most likely a negative delta of loans, despite the fact that both 2021 and 2022 were years of credit expansion, significant credit expansion. Again, I don't think that we have a credit crunch. I believe that over the next quarters of the year, we're going to see credit growth. But definitely, credit growth in 2023 is going to be lower than the one in 2022.
Okay. Are you seeing the same thing? Do you have a concern on that front?
I mean, I think when we talk about Greece, we got to remember where Greece is in the cycle.
Yeah.
Okay.
Yeah.
We have come out of a 10-year cycle of drop in GDP. Households and firms under-leveraged. It's 50-60% of GDP leverage compared to double that in the US and in most European countries. There is momentum from all the restructuring that has been done over the past year. So we're entering this crisis with strong momentum. I mean, banks do as well as the economy, especially in a bank-centered economy like Greece. So we had high growth in 2022. We're going to have much higher growth in 2023 than most European countries. We're 2.3, 2.4, 2.5, even higher as the numbers are going. So in that sort of strong economy with real estate prices going up rather than down, employment being created, high firm profitability, you're not going to see a significant drop in loan demand. Slowing, perhaps. Mostly, I'd say, in the household sector. But in the corporate sector, I think we're going to see strong, and we have the RRF funds. We have foreign direct investment coming in. All this is not going to lead to a crunch.
Okay. Let me ask you about. You go ahead.
Peter, if I could add one point here, I think the combination of the mini banking turmoil that we have seen over the last few weeks, and definitely the tighter credit conditions that we realize one way or another, could make the central banks revise the pace at which they increase rates.
Yeah.
And some analysts even argue that we may see within 2023 reversing their course, at least one central bank. In May, we have the next meeting of the ECB about interest rates. In my view, it would not be a surprise if we see the ECB decelerating, reducing the pace at which it increases interest rates. In my view, at least, increasing interest rates by 25 basis points instead of 50 this time would leave more optionality for the ECB on the table regarding any sort of future moves.
Let me just grab on something what you said, which is the corporate sector and lending into corporate finance. Because I was reading the S&P upgrade recently, and it was interesting to me the focus they put on the banking sector, the health of the banking sector, and the really significant increase in investment in this country. Tell me a little bit about that, how that has played through the banking system, because I guess one of the sure signs of a healthy economy and a healthy banking system is the origination of loans to companies that are investing in the real economy. There's been some argument that a lot of the growth of the last 2 years has been consumption-based. So, sugar rush because of stimulus in the pandemic and stimulus because of the energy sector. What do you see in terms of benefit on your loan book on companies coming to you and saying, I want to invest in the real economy? And how much it is domestic investment, and how much are you seeing even foreign companies coming in and wanting to originate loans and get some financing for work here?
Again, we're in a very positive part of the cycle because we're seeing both foreign interest as well as domestic interest. Greece, after the crisis, had fixed investment as a percentage of GDP in single digits. And on a net replacement basis, almost zero. We're bouncing back. I think we're now 13, 14% of GDP. And I think that will continue to go towards, converge towards European levels of 18, 19% of GDP. That is a lot of bank loans.
Yes,
okay? Because it's basically the banks that are going to provide that financing. So the interest in Greece, it's competitiveness, and I would say that we didn't have consumption-led growth. We've had investment-led growth, and we've had export-led growth, which is very positive. Okay? Consumption's been relatively stable as a percentage.
Okay.
So all the signs are positive for the banking sector that there'll be strong demand from corporates for specific investments, energy, tourism, and others. Okay, so.
Can you add some color on that? When you're looking at corporate loans, origination, what sectors you're looking at, what foreign versus domestic?
Let me emphasize that it is of paramount importance for the Greek economy to see investments going forward. It is not consumption that will bridge the gap that exists between Greece and the Eurozone and the other Eurozone members. It is investments. Therefore, as banking system, it is our task to facilitate investments. And indeed, if you look, all the major infrastructure projects in Greece are funded by the Greek banks. All the major projects for the green transition or for the digital transformation also are financed by the Greek banks. Foreign direct investments, which are at record levels both in 2021 and 2022, are facilitated by financing provided by the Greek banking system. So overall, I think we are in a very good position to promote the investment cycle in our country. As I said, this is of paramount importance for the growth of the economy over the next, let's say, 5 years.
Can I just follow up on one of the things you raised, which is the foreign direct investment and the extent to which foreign companies rely on Greek banks? Because obviously, as a foreigner in your lovely country, I focus a lot on this. So are you seeing that the multinationals that come into Greece are relying on the Greek banks as opposed to coming in and using their own Deutsche Bank or Commerce Bank, or is there a mix there, or competition there?
I would say they rely almost, if not 100%, on Greek banks.
Okay, and you're seeing that as well?
Yeah.
All right, last topic because we're running out of time. The other thing the S&P report highlighted, which I must say I have missed because I've been back in the US for 4 years now, is the incredible work through with the NPLs. Tell me just very briefly about how that was achieved, but also how that frees up capital to loan into the real economy. You know, what does that mean for the real economy in terms of the financial system able to sort of do its job?
I mean, initially, we had need for capital to build up provisions and to clean up the NPEs. We had almost 50% of our loan book was NPEs.
Not performing.
Now, on a net basis, we're at a few billion, okay, versus a capital base of 22 billion, 25 billion, something like that. So,
amazing, yeah.
so we've managed to not have competition for capital from the NPEs. That's gone. So that has been very, you know, so now we have the capital to lend, and that's so the NPE issues has disappeared, I would say, from the horizon. We still have a little bit more to do, but it's no longer an issue. Okay.
I was going to ask you to follow up, but I'm getting the hook from the organizers here. First of all, it is a great pleasure to come to Greece for the good news in the banking story, having left the U.S. where the bad news of the banking story is. Please join me in congratulating these two men and thanking them for their comments.